Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into the consulting and technology powerhouse Accenture, ticker ACN. We're looking at a company that is really managing this massive strategic shift, the AI revolution. At the same time, it's navigating the immediate threat that same revolution poses to its own business model. It's a classic high-stakes game of eat or be eaten.
And our analysis shows they are absolutely choosing to feast. We've synthesized their latest filings, their forward-looking statements to really understand their precise strategic response. The core thesis here is that Accenture is proactively driving a, quote, total enterprise reinvention built on advanced AI. They're doing this by converting a massive early $3 billion investment into accelerating bookings. And this, we think, justifies the long-term thesis despite this historically deep stock discount and the near-term revenue deceleration that's being caused by some federal headwinds.
That thesis sets up the core conflict perfectly for you, our listener. You need to know if ACN is just a traditional consulting firm that AI will, eventually automate, making it obsolete. Or are they truly executing a strategic pivot massive enough to guarantee them a position as the indispensable guide through this next wave of disruption? We really need to discern whether the current stock price is a fair reflection of structural weakness or if it's a deep mispricing of their future potential. Let's start, as always, with the hard numbers for fiscal year 2025. Every strategic bet has to be funded by financial health.
Absolutely. And when you look at the financials, you see a company operating from a position of profound strength, which is just critical. It provides the essential foundation for this huge strategic bet on AI. Total revenue for fiscal year 2025 hit a very robust $69.7 billion.
Okay, almost $70 billion.
Almost 70. And in the current kind of choppy macroeconomic environment, that represents a solid 7% growth over FY24. That's both in US dollars and local currency. That kind of top-line growth, approaching that $70 billion mark, it just signals consistent demand for their core services even before this AI wave fully hits.
7% growth is healthy, but we need to look beyond the top line. I mean, anyone can grow revenue by spending wildly or, extending payment terms. Accenture has always prided itself on being financially disciplined. So what does the quality of those earnings look like?
The capital efficiency here is, I think, key to the entire thesis. When we look at cash generation, the numbers are, well, they're stellar. Free cash flow, FCF, was exceptionally strong at $10.9 billion.
$10.9 billion.
Now, that is a massive number in absolute terms, and it represents a huge 26% year-over-year increase from the previous fiscal year.
That kind of jump in FCF, that's not just growth. It speaks to operational tightness, superior cash management. For you, the listener, who might not track these metrics daily, why is that $10.9 billion free cash flow figure so important for understanding this pivot?
It's the lifeblood of their transformation. I mean, FCF is the cash left over after paying for operations and capital expenditures. This is the money they can freely use for M&A, for shareholder returns, and critically for those huge multi-billion-dollar strategic investments in AI. And furthermore, we look at the ratio of FCF to net income. It came in at 1.4.
Okay.
A ratio significantly above 1.0 signals that their reported net income is backed by high-quality physical cash generation, not just, aggressive accounting or non-cash items. This proves the financial performance is real, and it fully funds the strategic risk they are taking.
And the bottom line, EPS.
Looking at the final bottom line, their adjusted earnings per share came in at $12.93. That's achieving 8% growth over the adjusted FY24 results. So they're growing the business, improving cash flow, and increasing profitability, all while funding a generational shift.
Okay, that financial muscle allows them to make the move. So let's unpack the strategic shift itself, because Accenture isn't just adding a layer of AI to existing work. They have fundamentally renamed and restructured their entire service catalog. This signals a real structural pivot.
Correct. This is not incremental. It's a full-scale rebranding of the enterprise mission. Accenture has unified nearly all its offerings, from traditional strategy and consulting to tech, operations, specialized industry groups, into one consolidated banner, Reinvention Services.
Reinvention Services.
It emphasizes enterprise-wide transformation powered by AI, data, and cloud. They were no longer selling isolated consulting projects. They're selling the complete end-to-end overhaul of a client's business model.
I find the terminology they're using to describe their people incredibly insightful. They're calling their workforce reinventors. That's smart, yes. But more importantly, it signals they're moving away from that old model of just being expensive generalists who drop in and write a report. They're trying to position themselves as these bespoke transformation architects. But are they delivering the talent to justify that new price tag?
They believe they are, and their client base certainly trusts them to try. Their scale provides this enormous advantage in selling these complex transformations. They serve approximately 9,000 clients, including three-quarters of the Fortune Global 100 and 500. But the real evidence of their stickiness, it's the client longevity.
I'm like what he's talking.
195 of their top 200 clients have partnered with Accenture for a decade or more. That deep established trust, that institutional knowledge, that's the currency they're leveraging to convince clients to undertake a total multi-year AI transformation.
So we have a company with robust financials, high cash conversion, deep client trust, executing a massive strategic shift. Now, if they are so healthy, why did they report a massive, kind of controversial expense item this year? The company initiated a restructuring that involved a significant financial charge. Where does that pain fit into this otherwise bullish narrative?
That's the critical question, and it's where the short-term financial pain meets the long-term strategic necessity. To fund this massive reinvention and align their workforce with the future, they had to conduct a major cleanup exercise. This resulted in an expected total $865 million business optimization charge over a 6-month period, covering the end of FY25 and the start of FY26. We need to look at this charge as a calculated investment, not a failure.
That sounds punitive on the surface. For our listener, what exactly is bundled into that $865 million charge?
Well, the primary components address two crucial needs: talent and asset alignment. The charge included approximately $344 million for employee severance.
Okay, so that's the human cost.
It is. It's the practical, harsh reality of what they call talent rotation, which means exiting people quickly where reskilling simply wasn't viable or didn't meet the compressed timeline of client AI demand. The remaining significant portion, about $271 million, consisted of asset impairments. That's primarily related to divesting non-strategic acquisitions in the Americas that just no longer aligned with their new, hyper-focused AI and reinvention priorities.
This looks like the classic clean up and reinvest strategy, but on a massive scale. You take the pain of severance and write-offs now to fund future growth. What is the promised payoff? Because $865 million, it's not a small number to absorb.
Exactly. The expert insight here is that this large, non-recurring charge is explicitly expected by management to yield over $1 billion in cost savings.
$1 billion.
Over $1 billion. And that gets funneled right back into the business for future growth initiatives, specifically into AI and talent development. They're essentially using efficiency gains from the reorganization to create internal investment capacity. It's a deliberate, necessary maneuver when you're facing a generational technology shift. You have to shed the old costs and divert that cash immediately into the skills and technology of the future. The financial health of the company made this deep, proactive surgery possible.
Let's move to the engine driving this reinvention, advanced AI. This is where the evidence of successful execution has to appear. What proof do we have that the massive upfront investment, which we now know the source of funding for, is actually translating into accelerating future bookings?
This is where it gets highly analytical and I think justifies the long-term bullish outlook. Accenture made an early and decisive $3 billion multi-year commitment to generative AI starting back in FY23. We're not waiting for results anymore. We are seeing the direct fruits of that investment. The core data points validating this strategy are striking. In FY25, their advanced AI revenue tripled, reaching $2.7 billion.
Tripled.
Tripled. But the most critical leading indicator for investors is that AI bookings nearly doubled, surging to $5.9 billion.
That booking momentum, $5.9 billion in signed contracts for future AI work, that's undeniable proof that clients are buying the reinvention narrative. But it immediately brings up the existential threat for the entire consulting industry: deflation. If AI is the ultimate efficiency tool, won't it eventually automate tasks like coding, data management, drafting, which are huge revenue drivers for a service company, and crash the price clients are willing to pay? Isn't AI inherently deflationary to consulting services?
That is the most salient counter-argument, and management addresses it head-on. They explicitly state they do not see AI as deflationary for their business. Instead, they view it as fundamentally expansionary. They're positioning it similarly to previous generational technology shifts. Think of the move from proprietary custom servers to standardized cloud infrastructure, or the shift from analog to digital processes.
Right.
In every one of those cases, the initial deflationary fear that cheaper technology would reduce demand for integrators was proven wrong.
So we need to understand the mechanism. How do they ensure that AI's efficiency gains don't just reduce the total cost of their services and eat into their margins?
The mechanism is, well, it's elegant and relies entirely on Accenture's deep embeddedness in the client's organization. While AI absolutely boosts efficiency in areas like generating basic software code or optimizing back-office operations, management argues those realized savings don't just disappear into the client's profit margin.
Okay, so where does the money go?
The freed-up client budget is immediately reinvested into new, unlimited, and increasingly complex technology priorities.
So if I'm a Fortune 500 CFO
Yeah.
and Accenture saves me, say, $50 million on my existing IT spend using AI, I don't give that money back to shareholders. I immediately allocate it to the next massive transformation project that Accenture is selling me.
Precisely. The list of enterprise-wide transformations clients want to execute, from supply chain resilience to hyper-personalized customer experience, is, and I'm quoting here, virtually unlimited. When Accenture saves them money on one process using AI, that money gets spent immediately on the next transformation phase, which Accenture is uniquely positioned to manage and orchestrate. They essentially control the reinvestment funnel. This flywheel effect. It's the core defense against deflation.
To maintain that expansionary flywheel, Accenture can't operate in a vacuum. They aren't a foundational model company like OpenAI or Anthropic. They're a systems integrator. So how critical are their strategic alliances in executing this vision and controlling that reinvestment funnel?
Alliance power is foundational to their strategy. It's a key element of their competitive moat. Accenture aims to be the '1 partner for the entire tech ecosystem, translating raw technology into business outcomes at scale. And the results are clear. In FY25, over 60% of their total revenue was generated from work done alongside its top 10 ecosystem partners, the largest tech companies in the world. Their revenue growth from these alliances actually outpaced their overall company growth.
So the partners are where the expansion is really happening.
It's where it's concentrated, yes.
Give us some specifics on who they're working with and how this is translating to deep, real-world deployment, especially with the foundational models that, everyone is talking about.
They are deeply integrated with all the heavy hitters. With OpenAI, they are launching flagship programs. They're rolling out ChatGPT Enterprise for tens of thousands of their own professionals internally.
So they're eating their own dog food, so to speak.
They are. And they're focusing on creating the largest number of professionals upskilled through OpenAI certifications. This reinforces that internal reinvention mandate. They're training their own people faster than anyone else. And similarly, with a key competitor to OpenAI, Anthropic, they are actively engaged in training 30,000 professionals on Claude models. They're hedging their bets, ensuring expertise across the leading platforms.
But the next level of complexity goes beyond just using a large language model. It moves into what they call agentic AI, where the system is autonomous and handles multi-step tasks. I see their joint effort with Google Cloud is accelerating, particularly in this niche.
That alliance is a major competitive edge in the orchestration layer. For you, the listener, agentic AI is a critical next step. This isn't just a smarter chatbot answering questions. Agentic AI is an autonomous, multi-step system that can execute an entire workflow like optimizing a supply chain or processing an insurance claim from end to end. It coordinates multiple smaller AI tools. Accenture is expanding their joint generative AI center of excellence with these capabilities. They have already built more than 450 agents that are available on the Google Cloud Marketplace. This positions ACN as the leader in orchestrating these incredibly complex multi-agent systems.
We need concrete proof that this isn't just theory or, some pilot programs. Do we have a tangible example of this agentic AI work in action that proves it can drive revenue and quantifiable savings at scale?
We have several, showing both revenue growth and massive cost efficiency. Take the Radisson Hotel Group. They partnered with Accenture and Google Cloud using Vertex AI and Gemini models to personalize ads at scale. By training AI models on massive customer data sets, their ad teams saw productivity surge by 50%, and the result was tangible revenue. An increase from AI-powered campaigns by more than 20%. That's direct, quantifiable financial impact. And another example, showing operational efficiency, is the work with Ecolab. Accenture helped them redesign their entire lead-to-cash process using 9 scaled agentic AI agents. These agents now handle tasks that previously required extensive manual intervention. The result, 60% automation in cash application, which used to be a 100% manual process. This directly supports Ecolab's path to delivering an estimated 5% to 7% sales growth without needing to proportionally increase costs in their back office.
That's compelling evidence. The $3 billion AI investment isn't just sitting in a lab. It's being deployed and driving quantifiable client benefits that validate the core thesis. But executing such a massive pivot while simultaneously growing requires more than just smart alliances. You need to rapidly acquire new capabilities and new people.
That brings us to our next section, scaling capabilities through aggressive M&A and talent transformation. This strategic goal is addressed through extremely aggressive, targeted inorganic growth. They spent $1.5 billion on 23 strategic acquisitions in FY25, adding skills, capabilities, and deepening industry expertise. However, the commitment for the upcoming fiscal year, FY26, is even more aggressive.
How much more?
They plan to invest approximately $3 billion in acquisitions in FY26. They're essentially doubling their spend on M&A.
Wow. Doubling the M&A budget speaks to a real urgency to capture niche expertise quickly before competitors can. What areas are they prioritizing with this enormous infusion of cash? Are these acquisitions just bolting on revenue, or are they filling capability gaps?
They are highly targeted capability fillers. They're often focusing on highly regulated or capital-intensive sectors where the complexity of integrating AI is highest, which, deepens their moat. For example, they acquired Sobin in Scotland, IQT Group in Italy, and Bolzlan in Spain. These were strategic moves made specifically to scale expertise in large-scale capital projects for critical sectors like energy, utilities, rail, aerospace, and defense. These massive multi-year projects require deep, specialized skills that are just nearly impossible to build from scratch quickly.
That makes sense. They are buying their way into complex, high-margin, regulatory-heavy environments. And I noticed a particular aggressive focus on a very high-profile data platform, Palantir. This seems like a massive specific bet.
It is a crucial integration strategy, especially for the high-security federal and defense segments. Accenture made specific acquisitions like Deco in the UK and Ranjawar Data in the US explicitly to scale their expertise in integrating and utilizing Palantir's Foundry and AIP platform. Management noted that the partnership with Palantir is playing a critical role in the federal space, where demand centers on modernization, consolidation, and efficiency, all areas where Foundry excels.
But let me challenge that decision slightly. Palantir is known for, controversy and specific use cases that might be polarizing. Isn't linking their aggressive M&A to a specific high-liability platform like Foundry a massive bet that could narrow their addressable market or maybe expose them to increased reputational risk if that platform faces scrutiny?
That's a fair challenge, but Accenture's focus is on the scale and complexity that Palantir addresses. By acquiring expertise in Foundry, they're doubling down on highly regulated clients, government agencies, defense contractors, large manufacturers who already operate in high liability environments and demand the unique data integration and security provided by Palantir. So this isn't about general market appeal. It's about cementing indispensability in the most secure, high-value client segments. They view the expertise as a competitive edge, not a risk, in the specific lucrative markets.
Okay, let's pivot from buying expertise externally to managing the massive workforce internally. They can buy $3 billion worth of expertise, but they also have hundreds of thousands of existing employees. How is the internal talent rotation strategy managing that enormous transformation?
It's perhaps the biggest management challenge in the entire company. It's a delicate dance between upskilling existing staff and making difficult rotation choices. The goal is clear. They are aiming to grow their specialized AI and data workforce to 80,000 professionals by the end of FY26.
Yeah. 80,000.
To achieve this, in FY25 alone, the company invested $1.0 billion in learning and provided 47 million training hours to their staff. They state that investing in upskilling is their primary focus, confirming that over 550,000 of their reinventors are already trained in the fundamentals of generative AI.
That level of internal training and investment is staggering. But the reality of this transition is harsh, which is where the financial charges we discussed earlier become relevant again.
They absolutely do. This immense upskilling effort is directly paired with the painful side of the talent rotation, reflected by that $344 million in employee severance charges. Management calls this exiting people in a compressed timeline where reskilling is not a viable path for the skills we need. That's the harsh human cost of a generational technology shift. It reminds us that these billion-dollar strategic pivots involve difficult choices about rapidly aligning their legacy workforce with accelerating client demand.
And to make this a sustainable model, they're even acquiring companies specifically focused on their learning platform, LearnVantage. They see training not just as an internal cost, but as a critical integrated service they can sell to clients.
That's a crucial insight into their holistic strategy. They recently completed a tender offer to acquire Atomy Inc. in Japan. Atomy's core expertise is in AI and digital transformation support. Integrating Atomy strengthens Accenture's LearnVantage service, which provides end-to-end AI support, from developing client talent all the way through to organizational adoption. This acquisition confirms they view talent development as a critical, high-margin service offering.
We've built a strong, evidence-based case for Accenture's long-term strategy and aggressive execution, robust financials, accelerating AI bookings, and proactive talent alignment. Now, we must define the risks. What are the near-term headwinds that are currently dampening their revenue growth and perhaps holding down the stock price despite all this momentum?
This takes us to our next section. The primary, quantifiable drag causing the near-term revenue deceleration, particularly in their short-term guidance for FY26, is reduced federal spending. This relates specifically to their AFS Business Accenture Federal Services.
Why is the federal business slowing down so significantly right now? Is this a failure of execution or a broader budgetary issue?
It's a broader budgetary issue tied to the procurement confidence cycle in Washington. The federal procurement process is often lumpy, and general budget uncertainty or, political gridlock can cause agencies to delay major multi-year IT modernization contracts.
How significant is this drag in the context of the nearly $70 billion overall revenue?
It's significant enough to directly impact their guidance. This federal business contraction is expected to cause a 1% to 1.5% negative impact on overall FY26 revenue growth.
Okay.
Management noted that this federal business is actually contracting in the mid-teens in the first quarter of FY26. So while it's a specific segment, it's large enough to act as a substantial anchor on the consolidated results.
It's a real drag.
It is, for now. But they are seeing some initial green shoots, mentioning that procurement confidence is beginning to improve, driven by demand for modernization and AI platforms in the federal space. But for now, AFS remains the clearest headwind.
So we have a healthy company with a multi-billion-dollar high-growth AI bookings pipeline, dealing with one specific temporary headwind largely outside their control. Yet, if we look at the market, the stock is trading like a company facing terminal decline. This brings us to the core valuation disconnect.
This is the central paradox in the opportunity for ACN investors right now. Despite the strong fundamentals, the high visibility thanks to large bookings, and a demonstrable path to AI leadership, the stock is trading at a significant discount relative to its own historical valuation. The forward price to earnings, or PE ratio, is currently hovering around 18x.
18 times. That number needs context. How does that compare to what the market usually pays for a dominant secular growth consulting leader like Accenture?
If you compare that 18x dramatically to its 10-year historical average PE of 27.14x, that is a monumental gap. This is not a slight dip, it's a profound disconnect. The market is pricing ACN as if its growth has structurally slowed, or as if that deflationary AI threat is already winning.
So what does that mean in practical terms for the listener? If the company is successfully executing its reinvention and the market eventually catches up, what's the implied upside potential?
If the stock simply traded back to its 27.14x historical average multiple, just based on market sentiment adjusting, that would represent an immediate 50% upside from current levels, even if the underlying earnings didn't grow another dollar. Analysts are calling this disconnect significant enough to be a generational buying opportunity, arguing that the market is excessively fixated on the near-term macro environment, particularly the federal headwinds, and entirely ignoring the accelerating AI bookings.
We have to maintain a balanced view. While the stock looks cheap relative to history, there must be structural reasons for caution. What are the material, operational risks that Accenture itself cites in their 10K filings beyond the federal spending cuts?
Right. The 10K filings lay out several substantial material risks. First is just fierce competition. This industry is brutal, and the contracting practices of rivals, particularly those willing to accept lower margins for market share, can force unfavorable terms. Second, and highly relevant to their core AI strategy, is the unique risk of IP infringement claims. The legal landscape for generative AI is evolving rapidly and remains highly ambiguous.
Right, nobody really knows who owns what yet.
Exactly. Accenture faces uncertainty concerning the scope of patent protection for AI models and outputs. As they deploy hundreds of new agents and models for clients, the risk of a third party claiming that their AI solution infringes on existing IP just increases exponentially.
And what about the risks associated with being a massive, sprawling global operation that relies on talent centers around the world?
That falls under geopolitical risks. Their business model is dependent on their global delivery capability, with huge portions of their workforce concentrated heavily in India and the Philippines. Any geopolitical instability in those regions, or even the rise of nationalistic trends that discourage outsourcing, could severely impact their operational efficiency or cost structure.
They also note a structural risk associated with their place of incorporation. They're incorporated in Ireland. What does that mean for the average shareholder compared to a U.S. incorporated entity?
It's a long-standing structural risk, but an important one. It means Irish law differs from U.S. law and might afford less protection to shareholders. For instance, the U.S. currently lacks a treaty with Ireland for the reciprocal recognition of civil judgments. It's an element of structural risk that institutional investors factor into their valuation models.
Okay, we have the full picture. Strong fundamentals and accelerating AI momentum set against near-term federal headwinds and a historically low valuation. Let's synthesize this into the final verdict on the investment case. Why should institutional investors look past the headwinds and demand a re-rating of this stock?
The investment conclusion rests on their ability to deliver predictable, high-quality growth while simultaneously accelerating investment. Accenture is guiding for an achievable 5% to 8% adjusted EPS growth in FY26. And crucially, they are delivering this growth while absorbing major strategic investment costs. The $3 billion in M&A, the $1 billion in training. This signals a tremendous amount of internal financial strength and confidence in their long-term AI thesis.
And they are being extremely transparent and aggressive about rewarding shareholders right now, which is a classic lever used to force a multiple re-rating by attracting institutions focused on yield and returns.
Precisely. They boast a highly shareholder-friendly capital structure. They are committing to return at least $9.3 billion in cash to shareholders in FY26.
That's a huge number.
It's a significant increase of $1 billion over FY25, and it includes a planned 10% dividend increase. This commitment to aggressive capital return, paired with sustained performance and accelerating bookings, should, in theory, pressure institutional investors to acknowledge the long-term value and move the stock closer to its historical average.
But we cannot conclude without addressing the critical structural counterargument that hangs over the entire consulting world. Let's revisit the core dilemma. Will the operational efficiencies delivered by AI eventually automate consultancy itself? Will clients just bypass firms like ACN entirely? Is Accenture, in effect, training its replacements?
This is the AI-shaped wall theory. Analysts have noted that consulting employment across the industry seemed to peak shortly after the launch of ChatGPT, indicating a potential structural limit to human consultancy hours. If general-purpose Gen AI tools allow companies to handle complex software development or data processing in-house with smaller, highly skilled teams, the demand for armies of external consultants could fundamentally erode the industry's business model.
So, what is Accenture's ultimate defense against this existential threat? Where is the deep moat that AI cannot easily cross, allowing ACN to capture the benefits of this expansionary trend without being automated out of existence?
Accenture's defense lies entirely in scale, complexity, and regulation, the very areas they are targeting with M&A. Their strategy targets highly regulated industries like defense, major financial institutions, and large-scale utilities. The argument is that in these environments, simple automation is insufficient. For example, a client can use an AI tool for coding, but if that AI writes faulty code for a nuclear power plant's cooling system, the client wants a massive, trusted firm like Accenture holding the insurance and the liability. The need for external expertise, massive scale, specialized security clearances, and sophisticated liability management that deepens the moat. Where software is inseparable from life, safety, or complex regulated liability, AI actually creates barriers to entry, benefiting large, trusted players like Accenture.
So the thesis holds. ACN is navigating the disruption by being the biggest buyer and deployer of the disruption itself. They are turning the tool that could threaten their industry into their core product and their competitive barrier.
That is the core takeaway. They are betting $3 billion that complexity, scale, deep client relationships, and regulatory needs outweigh the basic deflationary forces of automation. And the accelerating $5.9 billion in AI bookings suggests their clients agree, at least for now.
That leaves us with one final provocative thought for you, the learner, to consider. If ACN succeeds in pioneering this AI-enabled consulting model, could its massive early investment in ecosystem partnerships, the deep alliances with OpenAI, Google, Anthropic, and PLTR, lead to a new era of dominance? Could ACN become the one indispensable firm capable of profiting from the expansionary AI trend, leaving smaller, less capitalized rivals far behind in the dust, simply because they couldn't afford the upfront $3 billion bet and the $1 billion annual training costs?
It's a compelling future to consider, given their aggressive stance. The next few years will truly test whether the current valuation discount is a generous gift or a warning signal of structural obsolescence.
A powerful note to end on.
Risk defined, portfolio protected.